Welcome, everybody. I've actually been chomping at the bit to get this panel discussion going. It's a great panel, and I think we're going to attract a really good audience. But let me get going by way of introduction. And this is a conversation between 4 African stock exchanges, security exchanges. It's an interesting mix of organizations. I'm going to start off by just introducing, firstly, I suppose ladies first, Loshni Naidoo from the Johannesburg Stock Exchange, the Chief Sustainability Officer. Welcome, Loshni. Peter Nalitolela from the Dar es Salaam Stock Exchange in Tanzania. Nicholas Kabaso from the Lusaka Securities Exchange in Zambia. And last but definitely not least, John Kamanga from the Malawi Stock Exchange in Malawi. So this is an interesting mix, and I'll explain just now why. For decades, African capital markets have been measured primarily by liquidity, listings, returns, and things are changing. Today, a new question is emerging, and that question is, can African exchanges become catalysts for sustainable economic development while still remaining globally competitive? I suppose sustainability reporting, climate disclosure, transition finance, impact investment, and ESG-linked capital is basically reshaping the markets worldwide. Africa faces a unique opportunity. So without further ado, I'm going to start off, I suppose, talking about the current state of the African capital markets. Okay. I think I'm going to start off, if you don't mind, with you, John. Okay. Currently, what gives you the greatest confidence and what concerns you most about African capital markets today?
Thank you, Kelvin. Indeed, the current state of African capital markets is quite vital in the current state. What I would say in terms of the confidence which we have is the strong economic fundamentals which are driven actually by the population. You find that currently, with regards to the population growth, the African continent actually is booming in terms of actually the youth or medium age of population. And based on that, actually the young population, as well as the urbanization growth, the digital transformation, all these actually they provide a space in terms of entrepreneurial growth. And these actually entrepreneurial growth, actually you find that at least they will be looking for actually finances. And like instead, I would give you an example in terms of actually in Malawi, we have actually the youth population, especially those who are now just graduating from actually the tertiary education. And most of these, one, they're looking in terms of I would say the urban housing, that is the infrastructure development. In so doing, you find that at least there is need for access of actually, I would say, long-term as well as patient capital to finance some of these, the infrastructure development. Above all, you find that at least in Africa in general, there's been also a growth in terms of the pension funds. I was listening actually to the President Ruto when actually he hosted the Africa-France Summit in Kenya about 2 or 3 weeks ago. He mentioned about the abundance of actually financial resources which are looking for investment. What is actually key in our case is basically to come up with bankable projects which would come up with those to access those resources. And currently, the statistics have shown that in Africa, in terms of the pension funds, as well as actually the insurance companies, as of 2025, there was about closer to 800 billion US dollars in terms of assets under management. And all these, actually, they're looking for areas where they could invest. And the capital markets becomes quite actually important and quite usable, quite accessible, such that some of these resources could be plowed into. And that's the message which actually you find that we, the capital market actually players, we are advancing to the general public, especially to the issuers, that the market is there because currently we're looking at the borderless aspect. You know, the funds are available, that is within domestically in terms of domestic capital formation, but also in terms of actually the regional access. As I've said, the African continent is in abundance of financial resources. And above all, there's been the discovery of actually the underground resources, which has attracted lots of actually attention from the Western world. And we believe that the stock markets or the capital markets would come quite handy in terms of providing long-term as well as actually patient resources to these sectors, so that at least they can be unearthed and then actually be productive, such that at least our economic development could be seen and be uplifted from where we are actually to the middle income aspects. So that's what I would say in terms of the status of the African. But basically, the major concern is that we have limited, I would say, liquidity aspect in terms of the liquidity challenges, that is in terms of number of listing. That's why you find that some of these funds, they are unable to access our markets. And then we also have actually limited. Of late, we have seen that most stock exchanges actually, they are grappling in terms of moving out from the equity space now to other vanilla products. You've seen that now, I mean, from our big brother, the JSE, you find that the number of equity listings are reducing, but now we're now going into other alternative products like the exchange traded funds as well as the REITs. And I believe that the capital market is now ready to occupy that space, coming up with these innovative products so that at least we can provide them to the investing public so that they can access. So in a nutshell, that's what I actually put in terms of the resources are there in abundance and the general public can access, though we have some challenges which we have. But above all, the capital market, especially the African capital market, is very much ready in providing those resources because we have enough financial resources under the ground. Thank you.
Okay, and on that, actually, John, let me just pick up that thread and pass this on to Nicholas at the Lusaka Securities Exchange. Nicholas, you are basically at the intersection between energy transition, dealing with a big challenge and an issue in Zambia, but also, you're the hub, one of the hubs around the critical mineral reserves. And, John spoke about this whole idea of what's under the ground. How, give us your view on what gives you the greatest confidence through your lens. And part of that is what I've just mentioned. And then also maybe just, share with us some of your concerns as well.
I'd wish to agree with most of the points around the natural endowment that most of us as countries have. Zambia obviously has been in the news lately for having discovered the critical minerals. We are actually looking at one of the largest investments from the US in terms of infrastructure. The Lobito corridor is coming up, quite very ably, and that's going to cater for, Zambia, Angola, and the DRC. Now, obviously, the story around that is trying to get to see whether we can have an easy passage for our critical minerals. If we have to look at it from the existing, natural commodities that we have been endowed with all along, Zambia and DRC have been quite very, highly, perceived in terms of having the most copper production in Africa. And that already gives you a sense that we are actually doing quite very well in terms of how we peer with other international, copper producing countries. So the very fact that these natural resources are actually there, we have got a great potential for Africa to be able to, exploit them and create ourselves a hub where we can then be able to supply much of what we have to the rest of the world. Now, obviously, that gives us a lot of confidence that if we have to be able to measure the actual, valuation of some of these resources, we truly have got what it takes for us to be able to uplift our markets, attract capital into our markets, and even redirect the sort of our economies going forward. And potentially, we can then be able to provide a hub of markets to the rest of the world. If you have to look at it from the flip side, what potentially could be some of the, concerns despite this rich endowment that we have within our resources? The biggest concern, obviously, is the kind of lag in policy in terms of trying to exploit this advantage of the local participants. the local beneficiation has actually been quite lagged in terms of how we can benefit as countries from these particular natural resources. So in as much as we've got a very young demographic, we must be very clear in terms of how do we perceive or position ourselves as a market to be able to ensure that the beneficiation actually benefits the future and not only for today. Most of these resources extracted from the African soil are being traded on a foreign market. Now, that already is an opportunity forgone. So what we are then looking at as possible opportunity, despite the fact that we've got an internationally recognized market for commodities elsewhere, we must be able to look at it internally for us to be able to bring these markets closer to home. If I can produce copper and exchange that copper from the Zambian soil, that will strengthen my local currency. It will also strengthen my capital markets, because capital then flow and be exchanged here. And that's exactly where we've missed opportunities. And if you have to look at the other side of the coin, for us to be able to activate our markets to a level where we can then take advantage of a natural endowment, we also need infrastructure. And again, to a point that John highlighted earlier, Africa is in dire need of very critical infrastructure, and some of these infrastructure could be inland and also, offshore. But for us to be able to pipe, these infrastructure, we need capital markets. It's only up to us to be able to get to see how we'll lever that particular, opportunity for us to leapfrog our markets into the next part of what we want to see in our markets.
Nicholas, I'm picking up on what you're talking about regarding beneficiation and around the impact of the critical minerals on the economy. I suppose my question is, what must change for the African exchanges to become globally relevant from an investment decision? At what point? And I know that the government plays a very important role right here with policy certainty and all of that stuff. How do we get it that, yes, there has to be beneficiation in the country, and that's going to attract a lot of commercial activity, and actually the funding and the capital markets in Africa need to play a part in creating an enabling environment for that to happen. I'm going to go back to you, Nicholas, if you don't mind. If you can just touch on some of that.
All right, no, thanks very much, Kevin. So what needs to change? I think I did mention partly, we need to be able to deal with the issue around policy. Policy has to be quite very enabling. We have had a lot of conversations around, how do we get to empower the local participants in these economies to be able to participate in the mainstream value chain. The biggest issue that has always come through has been the aspect of our markets are not deep enough to be able to attract capital, and that capital to be able to, cascade downwards into the, downstream into the other sectors that are also participating in these value chains. Now, I think the aspect around what, exchanges can do to make themselves globally, investment relevant has to be the nature of the products that we're looking at in terms of our markets. Some of these products obviously will answer the call around the lack of depth in our markets. So if I'm sitting in Zambia and I cannot, stomach the entire $2 billion that is being requested for from the mines, we then have to be able to, provide incentives where we can cross-sell ourselves across, other more liquid markets. And part of those particular conversations lead us into policy. So in as much as we are getting to exploit our natural resources, there must be deliberate incentive from the public point of view, where we're then saying that even as much as we're getting resources out, the listing of some of these entities must be on local markets. And these are things that we've been trying to advocate for as markets, where the government becomes quite very deliberate, that in as much as they're giving incentives to, mining exploration, there's a deliberate incentive for them to be able to let, part of that capital sit on the local exchange. That gives relevance to us as a market. We can then be able to absorb whatever amount of capital we can, but still outlay some of the other capital that is required to more liquid markets. For me, that's where we are supposed to be heading. The other component, obviously, is that we are dealing with a market where, ideally participation has been quite stunted, for the very longest time, either due to literacy levels and all those things. For us to be relevant to the needs of the market, the product sort of sophistication and structure must be answering to the call around where capital is sitting and the needs of what international investors are looking for. Now, that brings us into the legal and regulatory framework. Now, within that space, again, as regulators, we must be quite very agile in responding to some of the demands of international capital. And responding to that basically means then that we must quite be responsive to some of what other markets are doing and borrowing best practice from that perspective. If we can do that and create that sort of speed with which we respond to the market demands, I think it will help us to be relevant. I think for the longest time we sit on positions for too long a time until the opportunity passes us. Until that opportunity goes, that's when we want to come back and react to some of those issues. So regulation must be quite very agile, and also as a market in terms of the public policy perspective, they must be very clear incentivizing the local markets to be able to respond to some of the demands of capital in these particular sectors that we're looking at.
That's great. Thank you for that response. I think moving on from this, but on the same question, and I'm going to just direct this to Peter now. Peter, you are probably enjoying some of the fastest investor growth across African exchanges right now. I suppose a logical question is, what do you see as the recipe for African exchange like yours to become a globally relevant investment destination? I mean, you're doing it, what have you done differently? And I suppose, I know you're enjoying a lot more local investor as well, which is liquidity on the local front, but is the same happening with overseas investment? And if so, what have you done differently?
Okay, thanks, Kevin. So to start with what have we done differently? Number one, in terms of increasing just our number of investors, we've gone big in terms of our mobile platform, how much we invest in it, both money-wise as well as time-wise. How do we market it? It's helped us grow significantly. So if compared to the new number of investors that we have this year, we've already gone by 20% or so. Yeah, around 20% of what we were last year. And most of it is actually youth, which speaks also to the question that you asked earlier about what gives us hope is that there's a lot of youth investment that comes in. We're leveraging on that technology to get into these young investors who may not necessarily control the lion's share of the liquidity right now in the market. But in terms of number, in terms of them being active, it's helping us. But what we need to do then to now be more globally relevant and attractive investors is, on the one part, we saw a flight of foreign investors over the last 5 years or so, due to a number of reasons with what happened with COVID and global inflation, flight to safety, etc. But we haven't been able to attract a whole lot of those investors back in Tanzania in particular, because our policies don't always speak to each other. When you discuss about our FX regulations of opening up capital accounts, it's been very slow coming. So that's put a bit of a hindrance. Some of our neighboring markets, and recognizing this webinar, we're all members of SADC. We're at different stages policy-wise, but most of them have been a lot more liberal when it comes to opening up their capital accounts, being much more adaptive to international rules and regulations, which gives confidence to those international investors. But additionally, I will also echo what some of my colleagues are saying. If you look at the growth potential that we have, look at Tanzania, for example, in regards to green minerals, we have I think the fourth largest deposits of graphite, if I'm not mistaken, globally. Look at nickel, we have already a project that has started mining, and it's going to be commercially producing soon. We have around 2% of global nickel reserves, etc. So a lot of the growth areas globally are available, but how much of incentives do we provide for those investors that come in, because these are capital heavy projects too. So for us to be relevant, in short, we have to have very friendly policies and stability and the setup of those policies that speak to global standards. Number two, we also have to provide the incentives to say, okay, if you're going to give your license, you can raise your capital here. We're going to put certain waivers and conditions that you don't have to, let's say, have 25% free float share, which is the rule for our main market. But what we're going to allow you is have a special arrangement where a very small part of your capital is going to be sourced here locally, which puts us on the global stage. And then on the other part is then we say, okay, we have our local companies here growing as well. How many of them can also possibly look at going abroad? And one of the initiatives that we've been working on regionally here from SADC and Tanzania being also part of East Africa communities, how do we then approach all these global markets as one market, because an investor wakes up in the morning, they look at Malawi's $5 billion, they look at Tanzania's $13 billion, they say, I shouldn't have to wake up in the morning to waste my time on this. The only exception to this rule would be JC. But how do we work together to attract these international investors to say, we are one market, either as SADC or as EAC or as Africa, which is an ambitious project that we're working on as ASEA. How do we approach them as one market and saying, look, there are all these opportunities. We know a lot of you already are looking at our markets as foreign direct investments coming into mining, agriculture, oil and gas. There are some discoveries that we have in this region, East Africa. Kabaso was talking about some discoveries closer to Zambia. But then how do we say that if you're going to come into these markets and either mine or farm or fish or explore oil and gas, we are one market, so you can approach us as I have a project in Zambia, but I can source a little bit in Tanzania, a little bit in Malawi, a little bit in Zambia, a little bit in Botswana, and so on and so forth. So we have to be speaking one language as a region and saying, we have a growing investor base here. They're looking at traditional products. They're young and ambitious, so they'll adapt easily. Technology gives them access that maybe we didn't have when we were growing up. But now, as we move to the next phase, we shouldn't allow ourselves to be left out again. We're saying we have all these resources, investors are welcome and they're putting a lot of money in here, but we want a seat at the table so that you participate in our capital markets as well as you go the traditional areas of finance. So those would be my 2 cents for now.
Oh, that's really useful. Thanks, Peter. I think I'm going to get onto the case for a connected African market just now. I just want to ask Loshni something, if you don't mind, Loshni. I think sustainability, of which the JSE is a leader in Africa. You're fully aware of all the great initiatives that have taken place. Do you think, firstly, that, and I'll get to the impact of that just now, but do you think that sustainability could actually become a defining factor in the competitiveness of African capital markets? Do you think that it's, or do you think that Africa, people just want to look at the big commercial opportunity and at any cost? But I think that is my question to you. Is sustainability going to become a defining factor?
Kevin, thank you. Yes, definitely. Because it's not a theoretical discussion for Africa. It's a practical man on the ground reality. It's also a practical economic reality. Because as a region, we are already experiencing some of the most acute climate impacts: worsening heat, droughts, floods, water stress, food insecurity, damage to livelihoods and infrastructure. So, it's despite contributing the smallest share of total global emissions. So sustainability in African capital markets, it's not simply just aligning with global trends. It's about how do we respond from a real economy perspective to ensure resilience and long-term value creation for all of our economies. The second part to that is the financing of this. So there's quite a few reports out there that shows the gap between funding, the availability of funding and the funding required, and where the funding is actually being directed to. And I think one of the latest reports that I've seen is it's about $310 billion per year in adaptation finance that is required by 2035. And this funding is not going to be coming from government or philanthropic funding or even concessional finance alone. And this is where capital markets in all of our economies is going to be incredible in terms of how do you create access to this financing, and how do you direct it to those areas where we actually need it the most. In terms of, and I think this was mentioned earlier as well, that the other aspect is around the biodiversity and natural capital. So Africa's biodiversity is not just also an environmental issue, it is also an economic asset in terms of agriculture, water systems, tourism, fisheries, and how we build climate resilience, so that we have the broader economic development that we're looking to create. So from a JSC perspective, how we view sustainability, it's less about a compliance add-on and how do we integrate this into the market infrastructure. So that's the key thing, that where we want to get to in terms of how sustainability creates this competitiveness and how it builds resilience in our economies, is ensuring that sustainability is actually embedded as part of how we do business, a part of our market infrastructure. So I think, just quickly closing on that, it's important because our exposure is critically high, that financing gap is quite significant, and we need to protect our natural capital. So we need to approach sustainability, not just a tick box exercise as a compliance requirement, but as something that helps us build resilience, adaptability, long-term relevance, as well as readiness for the future. Thanks, Kevin.
I'm going to move on to this whole regional story. And we're all part of the SADC community. East Africa has got their thing going. Once again, we're dealing with 4 different exchanges in the same business, completely different. The JSE, $1 trillion market, focused on global competitiveness. You don't have the same issues as the other ones. Malawi, smaller, fast growing. Tanzania, digitizing, and actually, might I add, driving quite an aggressive sustainability agenda. And then Zambia, as we mentioned, minerals, energy transition, etc. We're all trying to build the same type of capital market here. Okay, so should each exchange embrace a different strategic role in Africa's future, or should we start actually pulling together? If we were building African capital markets from scratch today, and it's not such a long time ago, besides the JSE, obviously, that all these exchanges were established in the 1990s. But would we actually create 30 plus exchanges, or would we go and take a look at the BRVM model in West Africa, where 8 countries got together and combined all the diversity and the different needs and the different strengths and the different weaknesses together, and actually at a similar time to when the other African exchanges were established? And I think we can all agree that they've made great headway and are actually doing quite well. So, Peter, what's your view on this? I know we've had a conversation about it, and I'm talking about Peter and the exchange. I'm not talking about the Tanzanian government and what their view is towards the regional exchange. If you don't mind, if you can share with us.
Yeah, so if I was to make that call today, Kevin, I'd say that no, we don't need 30 exchanges. We need 1 exchange, and the moderator of that would make people may have different philosophies. I would echo what John said, and maybe you can have a borderless exchange. You can have sort of a distributed way of managing it, but at least have it in such a way that it's one market for all intents and purposes, in terms of people who are living within the region, if they want to do trade within, but also when other investors come in, they see us as one market. The challenge that we've had, and John alluded to it a little bit, is that the challenge, if you want to establish one, strictly speaking, exchange with a physical presence somewhere, it can work, and as like you said, it's proven to work, but sometimes there are all these small nuances. People will start saying, why do we have the office in Nairobi, not in Dar es Salaam or in Lusaka, not in Longo, and so on and so forth. So to avoid that, you can say, you know what, we can have one borderless exchange wherever you are, as it's seamless trading and don't see any difference. I think what's had to go back to the BRVM example is that they're trading on one currency. I think it's the CFA. I think that it's helped them. Whereas for us, convertibility of the currencies, macroeconomic policy, etc., sometimes put these hindrances. But coming back to your question, so I don't divert. If you were to ask me, I was in the position to make the decision today, I would say we need 1 exchange, because otherwise the hassles that we're going through right now, trying to do all these different integration projects. We have the SOR project within SADC, you have CMI projects within East Africa, and then you have ALP project in Africa. It says that we want to go to a point where we're 1 exchange, but there are all these roadblocks because it started as a fragmented piece, which goes back to the previous question around becoming relevant and how do you attract capital, etc. How do you make someone wake up in the morning in York and saying that I want to access this market because it's worth my oil? And how would you convince a company like Lifestone Metals or Shell to say that you can source capital here? It will only be if we approach this as one market with a market cap of 1.6 to we're heading to 2 trillion now, I think, hopefully soon, with a population of 1.6 billion people. If we approach it that way as a continent, then from the get-go, then you don't have to later on go back and try to reverse engineer what you should have started with from the beginning.
Nicholas?
Yeah, no, thanks very much. I think from my end, I would say, do we need one exchange right now? I think the answer is no. We don't need one, primarily because obviously we still have a lot of concerns that we need to deal with. The example of West Africa is a unique one, and I think our colleagues have done a lot of things together for the longest time. Which I think, if you have to look at our area where we are sitting, there's a lot of political, monkey business that is still not yet resolved. We are talking about one intra-Africa sort of, play, but we are not putting all the ducks in order. And if we have to get closer to the exchange, yes, we need one exchange in principle, but I think we are not at the point where we are able to operationalize the exchange. There's a lot of implications there. There's the issue of foreign currency, there's the issue of settlements, and then obviously the issue of harmonization of our, exchanges. Our legal and regulatory frameworks is quite very variegated across the continent and even across regions. If you ask me, putting my own, position on the table, I'll tell you for a fact, we do not need one exchange right now. I think we still have a lot of in-house issues to be able to close out. In principle, if you have to look at why we would need an exchange, we have got competitive advantages that we can play to the, that we can entertain. And if you have to look at markets like ourselves, we are not, very liquid in terms of cash awash. We have got markets like our neighboring countries, say Botswana. They've got the money, they've got the liquidity, they don't have assets. So that's where we come in, because we're an infant market, we can provide the asset pipeline that can potentially redirect that capital into our space. But again, to look at the legal and regulatory framework on either side, that's where we have got a lot of problems. And I think the political sort of smear, becomes the most dominant factor that must be resolved. We have got a very good example around the intra-Africa trade. If you have to look at the pronouncements that have been made by by the African Union to where we are now, we are not anywhere closer to actualizing those things. So we need to be able to build, national infrastructures that can then answer the call of whether we can then start harmonizing these exchanges. As at now, the variegation that we see across markets do not really give a very unique positioning for us to start talking about one exchange, because obviously there'll be one advantage and the other disadvantage across the different countries. I'll definitely be able to put that on the table. As in as much as it looks nice on paper, we have a lot of in-house sort of issues to be able to resolve as individual countries, and most of it has to do with infrastructure. They also have to do with the legal and regulatory framework, which I don't think we might even pass. To John's point, some of these conversations have been on the table from as way back as 2009 or even earlier, but we're failing to even move this conversation over the line. And I think the reason is not because we're not interested. The reason is because we're moving at different paces. In as much as we know to open up our markets, we have a lot of infrastructure issues to be able to resolve. And that, for me, is the reason why I feel even talking about the regional exchange is too premature until we get to a point where we can see eye to eye across the different exchanges. That would be my position, Kevin, ahead of time.
Loshni, could harmonized disclosure and sustainability standards accelerate market integration? It was mentioned just now by John that you guys are actually seen as the gold standard in terms of ESG and creating the guidance for climate and sustainability disclosure amongst your issuer member base. Do you believe that this could be used as a tool to be able to create harmony and collaboration between East African and SADC capital markets?
Thank you, John, for that sentiment, but I think we're not the only exchanges who actually have disclosure guidances out for their markets. And we've also seen quite a number of the other exchanges on the continent looking at introducing some kind of mandatory sustainability reporting regime. But back to your question around harmonization, and I think the important thing about, I'm not sure whether it's going to accelerate or create harmonization, but what it will lead to is better collaboration, but more comparability that should support investor decision making. So in terms of how they allocate capital and where capital flows, because there's consistency in the reporting across the different markets, it enables better decision making. And I think that's the key thing that we are trying to get to with all of this, because capital is not forgiving. Investors can tolerate complexity, and uncertainty up to a point. And if you've got different markets asking for different sustainability type of data or information, and issuers are reporting very differently across different markets, then we're building in a risk, which, all of these reporting standards and frameworks we're trying to eliminate. So the cost of understanding becomes too high a risk, I think, for each of our markets. With the introduction of S1 and S2, I think that's the biggest example in terms of, so that's that IFRS, ISSB, the whole acronym soup, that was probably one of the reasons why, that came into being, to try and, consolidate all of these various reporting standards so that there is a global baseline of sustainability disclosures that have that financial link, which supports investor decision making, supports the comparability. So whether you a company based here in South Africa or anywhere else in the continent, that when you're telling your sustainability story through a financial lens, that it's comparable with a company working, for example, based in Egypt. Harmonization can reduce friction. It can support integration. But I think the disclaimer, the caution that I want to put forward is the lens that we use. So which standard and which framework as a market that we put out there. So so if you look at IFRS S1, S2, that's one lens. That's the financial materiality lens. So it's looking at, sustainability related risks and opportunities, how they reasonably impact an entity's prospects, enterprise value, investment decisions. And an important lens for capital markets. I'm not disputing that, but I think we need to take a very hard look at us as Africans on this continent and the challenges that we face from a climate risk, nature risk perspective. And, we mentioned that earlier. So impact materiality is critical. So this is what, how a company operates, and those operations, the impact that it has on the economy, the environment, and people. And this is where real world accountability actually sits. So I think the broader point I want to make is harmonization is great. The lenses that we use is important, but we mustn't forget that reporting is not a beginning and end of itself. It is part of a sustainability journey. So we do want to see that balance of reporting, but how reporting on what you as a company or corporate is doing from a sustainability perspective. So I think it's important in terms of that balance. I think the last point I want to make about that is when we look at these reporting disclosures that are put out through companies, that the information, regardless of the frameworks or standards that we use, must be credible, it must be transparent, it must be comparable, it must enable efficient decision making so that it allows capital to flow where it's needed. Because again, like the financing gap that I mentioned, we need considerable capital to respond to the climate and nature risks that we are experiencing and potentially will exacerbate as time goes on.
So let's move now to the gentleman in the room. Each of your exchanges, while the JSE is pretty advanced at this stuff, I think, Peter, you've done a great job at becoming an emerging but leading exchange in the space. I think in Zambia, emerging. I think Malawi, there's a bit of work to be done, but all of you guys are looking at mandatory type of, guidance from some aspect. So I think maybe just starting with you, Peter, you have been on quite an aggressive sustainability journey for the size of your exchange. Maybe what what have you been doing? What has been the drivers, and how's it looking? What's the response been like?
Okay, so before I go on the issuance side, where we've seen some successes, I want to touch on one thing that Loshni said in terms of do you make this as a compliance requirement, a listing requirement, and what does that mean in terms of the cost of compliance? And this is a very topical challenge because, of course, figures vary from market to market, but I think roughly in Africa, they can go upwards to 50,000 to 100,000 a year or something like that. So it is a challenge. We have made it a requirement that listed companies here have to report. We have demanded that they report on GRI standards, but we haven't made it to a point where it's such a big stick and less of a carrot, to a point that it incentivizes companies from delisting. We ourselves as an exchange, we're also self-listed. So both as a regulator and being a self-listed company, we do comply. Whenever we do report annually, we do report. Initially started with GRI, but now we are embedding S1 and S2 as well. So at least it's been a journey whereby we've been working also with the likes of IFC. We've also been working with the various international organizations whenever they've been able to provide other technical expertise. Some organizations are in an advanced journey because they are part of an international group and they have to report anyways. So it helped them quite a bit. Now, how much further do you enforce it going forward? It depends on how relevant do we make it for Africa. I mean, at the end of the day, there are global standards to adhere to, and you can't just create your own taxonomy and then you stick to your own reporting rules and how you comply with things and ignore what everyone else is doing. But you also have to be cognizant to the fact that in the African continent, we don't necessarily have the size of the companies that other markets do have. And maybe also our issues that we face are not the same. So we have to make it relevant and consistent across the continent and obviously globally as well, adhere to global standards, but make it relevant enough so that it's affordable and it's an attractive tool. And like Loshni said earlier on, it's a business imperative, not a compliance imperative at this juncture. But something else that I want to speak to, which comes to our fixed income board, we've had some successes here in Tanzania where we've had a few issuances. If I look at our fixed income book, and this includes Sukuk as well, it's not a very big book at the moment. It's around $800 million or so, just slightly over 2 trillion shillings. But if I look at ESG, it's 37% of that, whereas you have your vanilla taking about 33%. And on Sukuk, while it's not part of ESG in its traditional sense, but it can be considered as part of the wider ethical ethical investing, so I would speak. So the success story has come from the fact that we've had issuers wanting to do this for a number of reasons. One part, attracting some of this DFI capital, which they did manage to successfully get, which then gave them the appetite to do more, and we got more from some of these DFIs coming through, not just wanting to invest, but to also provide the technical support, at least initially, to get these issuers to be ready. They also already to extent that we're able to cross-list on the Luxembourg Stock Exchange and even now on the London Stock Exchange as well. And once you have that first taste, when I want to, at this point, recognize NMB, which is our largest bank largest listed company by market cap, they were the first one to do this. Initially, they started small. The initial ticket size, I think, was around $10 million. But right now, the total size of the ESG book at the market is around $295 million. So over time, it starts small. And then once you get the success, you have an appetite. The investors trust you more. They come to you. Some of them will give you technical support to get you going. And then also the next issue learns from the hard journey that the previous issuer had to go through. One big success story we have as a market, we have the first and so far the only municipal issuing a bond, and it was a bond that was investing in water infrastructure projects. It took us a very long time to get that through because people hadn't seen any municipal or quasi-municipal institution issuing any security in the market, so there was a lack of trust on whether the capability of the issuer. But then there came the ESG angle as well, which we said initially we won't focus on that as a requirement to get it going, but later on we got it after it had already been issued to get it certified and listed, and that's given appetite to other issuers come through, and we have quite a few coming through the pipeline. So what that has helped us with is that we have in West Africa here, so we're talking about JC being a big brother in SADC and in Africa in general, but in East Africa, Nairobi Stock Exchange would be a big brother in terms of number of years of existence and size of the market. But we're at a point where Frank and the team, they come to learn from us. What are you guys doing right? And they also want to get some of our instruments cross-listed there. So what I would say to summarize is been a patient journey and work with everyone, work with some of these issues, particularly DeFi's from the beginning. They're happy to support you with technical skills, with initial seed funding to get the capabilities in place. And then they'll come and put their money in terms of investment. And the returns that they ask are sometimes much more friendly compared to if they had to put in hard currency risk for a local currency issuance.
Nicholas, if you don't mind, just give us some feedback on where you guys are at with this stuff, as well as the challenges that your members are having, if you don't mind.
Thanks very much, Kevin. So Zambia obviously has made some very, interesting strides towards full adoption of S1 and S2. Quite very ambitious, I must be able to state, especially if you have to look at the size of our market relative to what it is that we're trying to adopt. As that, I think 4 years ago, we did start the conversation around can we go full IFRS S1 and S2 adoption. And as we speak as now, as a market, we've been in the voluntary sort of adoption from that time going to date. What obviously has transpired to the points like my other panelists have spoken to, we have actually seen that companies that are, within the global supply chain have actually been able to comply for some of them. At least they're giving us the reports that are quite very close to what we expect. We have seen a lot of very, low compliance rates among other sort of, entities that do not have that global supply sort of, connection. And that potentially has given us a lot of worries. If you have to look at the compliance rates with respect to the voluntary adoption of these standards, we're sitting just about 50% for some of the companies, and the others are yet to kind of fully adopt. Now, obviously, the interesting, situation we find ourselves as a market is obviously the conversation around the cost element, with respect to, compliance. And most of them are actually looking at it from that particular perspective. And that's possibly one of the reasons we've picked up as to why even the compliance rates are a bit low. If you have to look at the way the market is sized here, these are additional requirements of audit for most of them, and are being billed separately from the other audited financial statements. Now, we have pushed back obviously to our main regulator in terms of just the implication of cost on the companies. And if most of them are going to start looking at these inherent cost of compliance, then it does not make our markets quite very competitive. And to the points that was highlighted earlier, we may be able to see risks of delisting from the market. And those are things that were pushed back, in terms of, what we are seeing. The other component in terms of the challenges we've had in the market is around data. I think a lot of these companies have not had clarity around what sort of data that is needed, and partly that's also contributing to low compliance rates among the other sort of entities that are not within the global supply chain, conversation. But now, how are we addressing some of these conversations? If you have to look at where we are as Zambia, we have had a lot of support as well from our cooperating partners. And in terms of where we are sitting in terms of regulation, we have moved as a market to what we're calling the risk-based supervision. And that has helped us then to incentivize the conversation beyond the compliance aspect to actual risk, based reporting. And that also helps us then to start cascading the emotions right with respect to all our listed entities. Because most of them could have been looking at it to be a compliance thing, check the box. But now what we're actually incentivizing the market is if we have to attract more capital, the risk, environment around where we're operating, even what they themselves are doing must be compliant to where the demands of international capital, even the local capital is sitting. So the risk supervision has actually helped us to be able to drive the conversation more close to home in terms of why we're pushing the agenda of more transparency, more disclosure, and more added reports that are coming through to the investors. Now, potentially that has helped us start now moving, closer to where we expect ourselves to be. But even what is interesting from our perspective as a market is the very fact that as at last year, we did have the taxonomy, introduced into the market, approved by the regulators. Now we have got a clear sort of direction in terms of which way we are going. And some of the work that we've been doing to help us to move over the line with respect to getting more clarity of reports is how then do we leverage, artificial intelligence to help our markets to be able to get more data. Now, some of these conversations, obviously, some of them are still in their, nascent sort of level, but we are actually getting a lot of comfort that with adoption of AI in terms of data reporting and data collection, we are actually getting to see that the reports are improving by the day. From the exchange point of view, we have actually launched what we're calling an annual compliance, monitoring committee that is comprised of our main regulators, our main professional bodies, the legal professional body, the accounting body, and some other experts within sustainability that are just helping us to read into these reports, get to find out what sort of, gaps are being identified. And from those particular gaps, we either try to inform policy or try to help these particular companies to be able to comply. The other issue that we're working with is most of our audit firms have also come on board, and we are working alongside most of them to be able to capacitate our market, both the investors in terms of understanding the reports, but also the issuers in appreciating what sort of reporting framework will be expected and how to collect the data. The other issue that we have obviously noticed around the market is that for most of these investors, like our institutional funds, most of them were lagged in terms of trying to adopt or move their investment guidelines to be more, closer to sustainability, investments. And what we have eventually seen on the market now is that the government has led the way. Now we have got a national government, national corporate governance code. Now, what that has done is it has helped us to close up on some of the gaps and weaknesses that we saw within our system with respect to sustainability reporting and the need why we need to go that route. So our National Corporate Governance Code has actually helped us to move over the line because now we've got a policy that potentially now is mandatory for all listed companies and even for just our markets to be able to participate. So with that in mind, we are actually helping ourselves to then start kind of creating an environment where our market can then be responsive to the demands of sustainability. And we are hoping, obviously, with the passage of time, we may not get full adoption by next year, which is basically the conversation now, because of the many complaints coming through. Their conversation around deferring, some of those, standards. And we're yet to get to see how the market will respond, potentially because Zambia is kind of very keen to international capital. We are actually seeing ourselves being aggressive to, full adoption. But again, we are actually getting to have a sense check whether we can move that fast in view of where we are as a market and also going to where the national policy direction is moving. Some of them are conflicting with the need for us to be very aggressive around the mandatory adoption of standards. So we might be able to get to see a very, kind of lagged approach. But otherwise, for now, what we're currently doing in terms of integrated reporting is already giving us a lot of comfort in terms of what they're reporting. But to be more aggressive around S1 and S2, the market has actually pushed back. And that's potentially where we are now. But we're still optimistic that when we resolve some of the hurdles we're seeing along the way, we can get to see how we can get to have a compromise beyond what we're having now, and obviously the disclosures going forward in terms of what is required by IFRS S1 and S2.
Whether it's voluntary or mandatory, at the end of the day, I mean, we speak to South African companies every day, actually listed and unlisted. And to be honest, the JSE guidance always comes up whether they are listed or unlisted, because it is seen as the North Star for what's going to come, right? And, Nicholas just spoke about pushback on S1 and S2, and then it's like, okay, well, that's, having to respond to that. And, so from a JSE perspective, is it a thing, or is it just, guys, we've got investors coming out of sophisticated global markets and they expect this? And then for the others, is this really an anxiety, a paranoia that we're just pushing on too hard? And I suppose also, Peter, you would be one to comment on that. But just going back to that question, Loshni.
You know what, we don't take this lightly because we we have. I mean, if you do a comparison of where we were, 5, 10, 15 years ago to the number of listings we've had on the exchange to where we are currently, I mean, that is a significant drop. So that is a concern. And that is also a concern when, the team, the issuer market reg team went through the whole process of re-looking at our listing requirements to see, where do we reduce some of the burden? How do we reduce some of the red tape while maintaining that, that governance and that making sure that there is still that trust, credibility in the market. So it is a balancing act, and that is something that we will continually maintain. And that's a position we've held when the conversations around mandatory sustainability reporting began, because we're saying we've gone through this process to reduce and make it simpler while maintaining governance. But now with the introduction of sustainability reporting, what would that look like? Because that's also an extra burden. So I think Nicholas spoke about the costs. So we did a study about a few years ago when we released the disclosure guidance, looking at the cost benefit analysis of sustainability reporting. And depending on where you are in terms of on the spectrum of maturity with the reporting, this can easily, if you've a company that just started reporting or thinking about it, it could easily work out to about 10 million rand. And that talks to, setting up systems, hiring consultants or employing people, capacity building, data collection systems, etc. That's a lot of money for, a small to medium enterprise. Especially when you don't have the financial resources or, the people capital to put these reports together. And assurance cost, I think Nicholas also mentioned, that's a separate cost on top of all of this. But here's the thing, a lot of companies, again, depending on where you are on the global value chain, there is an expectation that you have this type of information. So yes, Kevin, to your point, it is a balancing act, but there is an expectation that if you are part of the global value chain, this is something that you will have to do. It's not something that we're getting away from. But let's look at how we balance this and make it work in our context.
I'm going to move along now to this whole, what is double materiality all about? Okay, because people talk about it as this theoretical exercise where you look at the material risks of the organization, both outward, inward, etc., and it's all done in really nice formatting and studies for companies. But what does it actually mean? It means, like, what is our company's impact on society and the environment? What is the environment and society's impact on our company commercially, financially? But I want to know from you, Loshni, again, if you don't mind, and then I'm going to move to John. Is the concept and the original idea behind double materiality actually trickling down, okay? And the influence that you have over the capital markets sitting where you sit, is it actually moving the needle on impact on the ground? And can we quantify this? Is it something that is done in a coordinated fashion? Are we seeing the impact of this, Loshni? Because it is a very powerful tool, double materiality. It's very well, cleverly designed. But at the end of the day, is companies may be doing it in, with different intensity, different implementation, different measurement. Are you seeing the impact of this happening on the ground?
So this is the question all of us working in sustainability keep asking, whether what we're doing actually matters. So maybe just before I get to that, answering the materiality question, I don't think it's personally something that's new. I do believe we've given definitions to a lot of things that we've been doing in sustainability. So we actually have definitions, and we've separated and articulated this in a way that potentially people who are new to the space, who are coming in, it actually clears up some of the concepts and ideas that, potentially we've taken for granted because we've been in it for so long. So, I mean, yes, I'm happy that we've moved beyond the long conversations on trying to define even what ESG stands for, because we needed to shift and we needed to move. We needed to also bring people along, but get to the point where we're actually doing real work on the ground to deal with real world challenges. So the concept of that financial materiality, impact materiality, I think it's good in that it gives clarity and understanding of what we are trying to achieve with both. In terms of measurement, that impact materiality has always been a struggle. There's a number of methodologies out there that can measure social impact, environmental impact, etc. But in terms of have we actually shifted this in any real way? If we look at the reports on the SDGs and how badly we are tracking globally, if we look at, I think it's the Stockholm Resource Institute, I forget this thing, that looks at the planetary boundaries and how many we've actually breached so far. I think the short answer we know is that we haven't shifted enough. But maybe from a JSE perspective, one of the things that we are working on in partner with another organization, which we're hoping to release later this year, is we're trying to look at, from a company perspective, in terms of what we can control and the ambit of our mandates, has sustainability been embedded in companies? And then can we measure that impact? So, because I do believe that if sustainability is truly core to a business, if it's embedded in its business model, it's part of the strategy, it's part of the DNA of the company, then the decisions that we make, the actions that we take, the activities, etc., how we look at risk, how we look at the future, if we've truly embedded sustainability, then we should achieve that impact that we are seeking to achieve. So I'm hoping that study in the future does give us some of the answers. But the short answer, if we look at the SDG reports coming out of the countries, and if we look at where we are from a planetary boundaries perspective, I think we have so much more work to do, and we need to do this rather quickly.
I'm going to come back to something around maturity just now. John, I'm going to go to you now because when we look at the Malawi Stock Exchange, we see a massive opportunity. And the opportunity, and working in Malawi quite a lot as GCX, we've seen this opportunity actually come to fruition when you're working with a large listed entity that has the influence to impact environment and society. It's actually not such a difficult thing to do as long as you can connect the dots. But from an exchange perspective, John, do you think that the Malawi Stock Exchange has a responsibility to influence real world sustainability outcomes? And do you think there's a way of actually using that influence to move the needle on social and environmental impact on the ground? Certainly agriculture, energy are the two areas where we see the big opportunity, and I certainly know that we're working in that space with big corporates, and we can see that it's slow, but with sufficient resources can actually do a huge amount to drive socioeconomic development on the ground. But John, if you can just respond to that question.
The Malawi Stock Exchange actually has a pivotal role in terms of actually influencing some of these initiatives. I'll give you a background that when we are coming up with the corporate governance initiatives in Malawi, you find that at least the Malawi Stock Exchange was a key member of actually the corporate governance task force, to the extent that we are the pioneers in terms of establishing the Malawi Code on corporate governance. And the speaker himself was actually the first president of the Institute of Directors in Malawi. That is myself, until about 2 years ago, when I relinquished actually that presidency to somebody else. So the Malawi Stock Exchange, and out of that, the Corporate Governance Code, we are also the pioneers in coming up what we call the corporate governance for specifically for the listed companies. And based on that experience, you'll find that at least the Malawi Stock Exchange would be quite key in terms of actually influencing some of these initiatives, especially on sustainability reporting. And that's why we have also taken a key step in establishing actually some of actually the initiatives within our listings requirements. And then if you look at the Malawi Stock Exchange, it's one of the, I would say, a pinnacle institution in our economy. We find that at least it is one of the referral corporates in terms of some of the initiatives which have been undertaken. Currently, the government is coming up with what we call the green finance in terms of the carbon credits, and we are actually trying. They were trying actually to put us in terms of actually the task force, because we know we have actually some of our colleagues, especially under ASEA, the Egyptian Stock Exchange. The Egyptian Stock Exchange is in the carbon credits space, And having actually seen the Egyptian Stock Exchange, they contacted the Malawi Stock Exchange on how we can come in terms of assisting the government so that at least they can come up with some of these initiatives. So in terms of the within also in the corporate world, we are a member of actually the Malawi Accountancy Board. The Malawi Accountancy Board is actually a regulatory institution which looks at in terms of actually trying to guide as well as regulate the accounting profession in Malawi. And the Malawi Stock Exchange is a board member on that aspect. In so doing, because of our board membership, we are able actually to influence some of the initiatives within the sustainability space, which is happening in the listed companies, but it can overflow to some of the companies which actually are not listed. And the Malawi Stock Exchange is also a member of the Institute of Accountants in Malawi, what we call is ICAM. And I was with Nicholas just last week in Botswana, and I was invited just to participate as a member from the Malawi Stock Exchange. That could you be part and parcel, so that at least you attend this conference, so that at least as I come back, I should be in a position to cascade those materials, those initiatives, those knowledge to listed companies. But as listed companies actually they embrace these, they would actually be infiltrated to other corporates within the economy. So the Malawi Stock Exchange is been quite key in terms of participation, as well as being an influence partner with regards to actually the initiative on sustainability reporting. Because in our case, we are a member of the Malawi Accountancy Board, which is a regulatory body of the accounting profession. But above all, the Malawi Stock Exchange has been quite key in terms of establishing the Malawi Code 2, which is actually the Malawi Corporate Governance Code on all listed as well as non-listed companies. But above all, we tried to streamline in terms of actually the Malawi Code 2 with the listed companies. But above all, we also went ahead in coming up with what we call sector guidelines for corporates, as well as state-owned enterprise, as well as actually for the banks. So the Malawi Stock Exchange is quite key, and we have been quite key with regards to influencing as well on these initiatives. And I believe that because of our referral point as a pinnacle institution within the economy, we stand quite highly in terms of being referred to, even actually in terms of economic policies. When actually some of the bilateral donors coming in, you'll find that one corporate which they try to visit and get in terms of data collection, also in terms of opinion or monetary policy, financial sector policies, the Malawi Stock Exchange comes in quite key. And we believe, based on that referral point, we have actually an influence in the economy in terms of actually influencing some of these actual initiatives, especially bordering on sustainability reporting.
Before I get into the closing round, I'm going to want to ask one question to Peter around technology, because it seems like you've really embraced technology at the Dar es Salaam Stock Exchange, and you mentioned earlier, it's actually that technology has helped solve a little bit of your liquidity challenge. And interestingly enough, from the younger people in Tanzania, how do you think technology can reshape African capital markets over the next decade, Peter?
So on one part, it provides it democratizes capital markets. So, for example, what was secret for us, and I know it's worked in other markets, maybe where the poster child us, and I know MGX as well. MGX won an award during WFE's annual meeting last year. But I know most of other exchanges in the continent have done this similar kind of efforts, is that it democratizes capital markets by giving accessibility to every Tanzanian. We have capital markets are a fairly new thing to us in our continent. So someone sitting in somewhere up country and you don't have necessarily offices everywhere, not everyone has a laptop, having the market accessible on their phone has given them that access. So looking forward into the next few years, what that will do is bring capital markets much more closer to every person on the continent. For as long as you have a smartphone, and smartphones are becoming cheaper, technology, at least internet is becoming much more accessible, it puts the product on their hands. But it's not just accessing the market, but it's also the knowledge as well. So we also put information that we can, educating them. But one thing we have not done, but where envisage just going towards, is actually now producing products that are specifically produced, and the issuance and everything is happening in the capital markets. What we have done, other than help recruit retail investors in particular, we've also put IPOs on the digital platform as well. And we've also done provide 24 hours our market access, even if the actual settlement happens after the market opens, but at least you can put in an order before. And we've also integrated what we've done is leverage on the mobile revolution in the country. There are a lot more people that are financially included through mobile network wallets, but that don't necessarily have bank accounts. But if you have a mobile network wallet right now, you can KYC you, and then for your payments, you can just push from a mobile wallet. So that's also helped. Now, what if we go a next step further and say that we don't necessarily have to have an issuance process that has to go through this lengthy IPO process, but you can have something that can be put together quickly through mobile network operators and have it as a capital markets product. And also, certainly that was true. I've been around a bit, Kevin, in my career. I've worked the last 12 years in banking, but I had a short stint in telecoms, and this was a while ago. And for us to launch a product, it would take a matter of a couple of hours. I used to work with Airtel Tanzania. Vodacom has done something. We want to counter it. It's just a couple of signatures and have a product online already. So why do we have to have IPOs that take months on end? So that's an area we can get into where you have design a product, get it to market quickly, and the funds raised, how we can channel them into more productive areas of the economy.
Wonderful, Peter. Thank you. I'm going to get into the closing round. I don't know if we can just keep them quite brief. I'm going to go around the room, if you don't mind. Biggest opportunity for facing African capital markets today, Loshni?
Okay, I'm going to do the 30-second burst. I think the biggest is embedding sustainability as a fundamental in capital markets. So it's not a compliance add-on, but it's something that's part of the market infrastructure so that markets are able to allocate capital more intelligently. Thanks, Kevin.
Thank you. Nicholas?
Yeah, so I think I would also want to agree, but most importantly, just to make mention that Africa currently sits with the most opportunities. We have got the resources. We need to harness them well. But not only do we want to use the capital markets to consume and get the yields now, we must be able to get to see ourselves sustaining our markets beyond where our resources can take us. And that potentially means we prepare ourselves as a market to take off for the future. That, for me, is where the opportunities sit. Thanks.
John?
I'm looking at the mobilizing Africans' domestic savings, which actually would channel them into productive investments that would actually drive the economic development. But above all, I'm looking at that element of mobilizing the domestic resources, basically in terms of actually leaving the legacy. To me, I'm very passionate to the extent that the stock market should be used as a vessel which could pass on the wealth from one generation to another generation, which would register leaving a legacy to the humankind. Thank you.
Finally, Peter?
So the biggest opportunity that we have a lot of untapped resources. We have a growing, significantly young, but still growing in terms of the speed of population growth in the young population. So if we can then turn it up to what John said, if we can bring in those savings of capital, we already have the resources, we have the population, then we just have to get them onto the market.
Gotcha. And in the same order, can we just talk about what's the biggest risk facing African capital markets, Loshni?
I think for me, it's the balance between regulation, so it's giving governance aspects versus flexibility, adaptability, and speed to market. It's making sure that we can maintain that balance so that we have credibility as well as speed.
John?
Basically, we are looking at in terms of regulation and then allowing innovation as well as allowing innovation on product development, such that the investors or the market is able to innovate other than strictly relying on compliance without actually leaving the market or the issuers to be innovative, so that at least they would allow for the wealth creation aspect. So it's balanced. So basically, it's trying to balance on regulation as well as innovation.
Okay. And Nicholas, biggest risk facing African capital markets?
Well, I think for me, the biggest risk obviously would be around how we harness our markets to obviously attract more capital. That will remain the biggest problem. And I think within that space, I think the policy framework must be quite very forward-looking. The current pace at which we are moving, policy is quite very lagged, and to a very large extent, that is impacting our economies. So we need to have a more agile policy environment for us to be able to pick ourselves to where the international capital markets are sitting. So for me, the biggest part of it will be policy framework, and also the legal and regulatory framework moving quite very slowly is the biggest risk that we have.
Peter?
I was saying indecisiveness, from where I'm sitting, at least from a Tanzanian context, I believe it's true for most African countries. We take too long to make decisions sometimes, and that indecisiveness leads us to losing opportunities, or at least by the time we step in, others have already miles ahead of us.
Are any of you dying to answer one of the two next questions? I mean, complete the sentence. The future African capital markets will be defined by, or are we happy to leave it where we're at right now?
I would say the last thing which I would add on in my case is that we need to build investor confidence in these markets, because the investor confidence remains the foundation of every successful capital market. If there is that erosion of investor confidence, then we'll find that at least we have no market to operate on. So the key aspect, let's harness and build investor confidence as a key foundation for a successful capital market.
Brilliant. Okay, then I'm going to ask the others as well. Complete the sentence. The future of African capital markets will be defined by what, Loshni?
Oh, I'm sticking to the sustainability theme in terms of how we actually respond to climate, nature-related risks and ensure that there is, longevity in our capital markets, in our companies, in our economy, as well as for our citizens, that, there is a viable future for them as well.
Fantastic. And Nicholas?
Well, Kevin, I'll be able to say they'll be defined by, quite a lot of innovative African-grown solutions that can potentially be the ones to pull in capital from wherever the capital is sitting, and they'll also be defined by a lot of domestic, African capital that will be piping up most of the, projects that we're looking at, within the continent. And that, for me, is where I see the African capital market seeing in the next few years to come.
And finally, Peter?
Yeah, so I would also say innovation. Innovation is key. You don't have to necessarily invent the wheel. What has been tried and tested can be still applied, but doesn't mean that we can't be innovative. And the mobile revolution has definitely helped us see that there are times whereby you don't really need to go the long road that others did. If there's a gadget that has come through landed on your hand, you can use that to expand accessibility to financing and communication, etc., to the rest of the population. So whatever innovation that comes through, let's make use of that.
Wonderful. Wonderful. All right. Firstly, a big thank you to all of you. I'm so grateful for you have made in the effort to prepare for this, to be here on the day. I can't tell you how much we appreciate it. I think just in closing, I think this discussion and the outcome of this discussion bodes well for Africa, the future of African capital markets. I think the leadership of these exchanges, represented by the four people on this call, gives us huge confidence that actually the sustainability issue or topic is being used in a very responsible way by the exchanges, and using the influence of these exchanges, I think is very clear to me that the outcome of this in the not too distant future will be felt and seen on the ground in Africa. I also believe that there is still a big opportunity to collaborate. I hear you, Nicholas, maybe not as one, but certainly as a group, a cohort of exchanges that work more closely together to learn from each other, to actually be able to consolidate resources, expenses of things, and to actually bring to the market a offering that is more unified to an outside investor, and where the risks are, I suppose, more closely managed.